All right, so let's get right into it. The U.S. stock market just snapped a pretty impressive record-breaking winning streak, and now, for the second day straight, everything's in the red. So what is actually going on here? Let's dive in and figure out why the market took a nosedive.
Right off the bat, you can just feel it. The whole mood has shifted. All that optimism we saw just a few days ago, it's kind of been replaced by a lot of caution. And this isn't just a vibe. The numbers are telling the exact same story. And we're seeing this pullback pretty much across the board. The S&P 500, the tech-heavy Nasdaq, the Dow, they're all down. Now, these aren't catastrophic drops, don't get me wrong, but it's the fact that they're all down that's telling. It signals this broad retreat from risk. So, the big question is, what's behind it all?
Well, it looks like this really comes down to a double whammy hitting investors all at once. First, we've got a cool down in the red-hot AI sector, and second, some very, very carefully chosen words from the Federal Reserve. Let's start with that whole AI story.
So the first major driver here is a continued sell-off in AI-related stocks. These are the exact companies that have been carrying the market for months. But now it seems like investors are hitting the brakes, maybe taking some of those profits off the table.
And it's not just that the big names like Nvidia and Oracle are down. Here's what's really telling. Even good news isn't helping right now. Micron came out with strong earnings, and its stock still fell. Alibaba announced a super powerful new AI model, and its stock stumbled too. This tells you that investors are just selling broadly, almost no matter what the individual company news is.
At the exact same time as this AI sell-off is happening, this quote from Federal Reserve Chair Jerome Powell basically poured a bucket of cold water on the market. He said there is, and I'm quoting here, no risk-free path to rebalancing the economy. Okay, so what does that actually mean for us?
What he's basically saying is that the Fed is walking a tightrope. They have to fight inflation, but they can't crush the job market while they're doing it. And that means they're going to be extremely cautious. For investors, this pretty much dashes any hope of getting quick and easy interest rate cuts this year.
Now, this combination, a cooling AI sector and a super cautious Fed, isn't hitting every part of the market the same way. In fact, as we're about to see, it's creating a really clear split between the winners and the losers. This is a textbook case of what investors call sector rotation. And here's that rotation in action. You can literally see money flowing out of technology stocks as they cool off. So where's it all going? Well, it's moving into sectors like energy, which is getting a boost from rising oil prices, and financials, which can actually do better in a high interest rate environment. And just how strong is that energy sector right now? Take a look at this. West Texas Intermediate crude oil, that's a key benchmark, jumped over 2%. That is a significant move that flows directly to the bottom line for those energy companies. Beyond these big sector trends, there are always these unique company stories playing out. Amazon, for instance, has been the worst performer of the Magnificent Seven lately, but analysts are still overwhelmingly screaming buy. Meanwhile, GM got an upgrade, and Walgreens just finished its move to become a private company. It's just a great reminder that every single stock has its own story. Okay, so that's what happened. But what does it all mean for what's coming next? Let's take a look at the outlook and what kinds of strategies investors might be thinking about.
So, in the short term, we're talking the next 1 to 4 weeks. The key word is caution. We should probably expect more of this choppiness. But if you zoom out a bit, over the next few months, the picture actually gets a little brighter. Historically, the fourth quarter is a strong period for stocks. And let's be honest, nobody thinks the long-term demand for AI is just going to disappear.
So with that outlook in mind, here are 4 potential moves investors are probably weighing. Number 1, carefully thinking about whether this AI dip is a real long-term buying opportunity. 2, maybe rotating some funds into those stronger sectors like energy and financials. 3, and this one is critical, holding off on any huge moves until we get the new inflation data. And 4, getting a strategy ready to take advantage of that historical fourth quarter strength.
All right, let's wrap this all up by focusing on exactly what you need to be watching over the next few days. This is your essential watch list. You're going to want to keep your eyes on bellwether stocks like Nvidia, just to get a pulse on the health of AI, and JP Morgan for the financial sector. Definitely watch those key sectors we've been talking about. But the single most important item on this entire slide is highlighted for a reason. Friday's PCE price index. This is the Fed's favorite measure of inflation, and that number is going to have a massive impact on their next move and on the entire market. Which leaves us with the million-dollar question that everyone is asking right now. Is this pullback in AI stocks just a healthy, short-term correction before we head to new highs? Or Are we seeing the very first signs of a bubble that's getting ready to pop? That data on Friday might just give us our first real clue.